Welcome to another tutorial video. This time we're going to be discussing what is real estate financial modeling. We're covering this topic because we have featured a lot of points about real estate valuation, property modeling, but we've never explained exactly what the purpose of it is and given you a step-by-step process to go from beginning to end of a real estate financial model. This tutorial is not at all an answer to a reader question. It's just an important topic overall, and it corresponds to a blog post on mergers and acquisitions. You can follow the URL on screen. It's also in the description below this video. Click on it and you can get all the Excel files and other resources that I go through here. So go to that link if you want to get all the documents, files, and resources here. We're going to expand on that article here and show you more of the Excel parts here by going through this in video format. Our plan for this tutorial will be to start by explaining what the point of real estate financial modeling is. Then we'll go through types of deals, properties, and models. Then I'll show you an example of an acquisition model, and then I'll show you an example of a development model and the key Excel bits required to get those both working. So what is the point of real estate financial modeling? First off, let's define exactly what we're talking about here. Real estate in this context means land and buildings that generate revenue or have the potential to do so in the future. We mostly focus on commercial real estate, which means that someone, an institutional investor or a wealthy individual or someone else, owns the property and then rents it out to other people, individuals, or to companies, businesses. We do not focus on residential real estate all that much, such as single-family owned homes, because it's a bit different. It's a different type of asset class, and it's not quite as likely in case studies and modeling tests. The purpose of real estate financial modeling is to analyze a property from the perspective of an equity investor, an owner or landlord, or debt investor, a lender, and then determine whether or not the equity or debt investor should invest based on the risks and potential returns of the property. To paraphrase, the real question here is to buy or not to buy. This, of course, is not exactly Shakespeare's quote, but I'm using it as a quick and simple way to remember what real estate financial modeling is all about. For example, if you buy a multifamily property, like an apartment building, for $50 million and you hold it for 5 years, could you earn a 12% annualized return on your investment? Real estate financial modeling cannot tell you if you're going to earn an 11.3% return or a 14.7% return because you're predicting future events. All investing is probabilistic, so you can't go down to this level of detail, but you can tell whether this range, 10 to 15% for the returns, is plausible, or if getting to that level would require unrealistic assumptions and unrealistic financial performance, therefore making it implausible. Let's now go into part 2 and talk about the types of deals, properties, and models in this sector. There are 3 main ways that you can invest in properties when it comes to commercial real estate. First off, you can acquire an existing property, you can change very little to nothing about it, and then you can sell it in the future. And this is called acquisition modeling. Another method is to acquire an existing property, change it significantly, and then sell it in the future, and this is called renovation modeling. And then the third method is to buy land, pay to develop a brand new property, find tenants for it, lease it out to those tenants, and then sell the property as soon as its net operating income and rental income stabilize, and this is called development modeling. Now, in addition to those different types of investment strategies and different types of models, you also have 4 main property categories. And really, if you limit it to commercial real estate, it's basically 3 categories, but I'll show you 4 just so you can see all of them on screen here. So first off, we have the office, retail, and industrial category. The customers here are businesses. The leases tend to be very long-term, at least several years. The details vary significantly between different tenants. Once we construct a new building, we aim to sell it after the building is done. And these are really all for business purposes. On the other end of the spectrum, you have hotels, which of course are for individuals, either business travelers or leisure travelers. The lease term, in quotes, is very short because most people only stay for a few days. If we build a brand new hotel, we aim to sell it after the building is done and income is stabilized. And then in between those two, we have multifamily. The customers are individuals who want to live there. The lease terms are medium term, we could say, usually about a year, and usually the terms are very, very similar. And once again, we aim to sell this after the building is done. The one that's really different is condominiums because it doesn't quite fall into the commercial real estate category. It's more of a residential one. It's owned by individuals and it's often pre-sold in advance. So even before the construction, the development is done, we aim to pre-sell these to our future customers. That makes it quite a bit different, and the fact that individuals actually own these, the fact that they're not leased out to people or companies also makes it different. We're going to focus on the other three categories in this tutorial for now. The main difference between all these property types is the lease. Office, retail, and industrial properties tend to use more granular financial modeling and often have tenant-by-tenant assumptions because the lease lengths and terms vary significantly. Hotels are a lot more like normal companies, and multifamily is in between. You can visualize it like this. On one side of the spectrum, you have hotels, which are closer to normal companies, and on the other side, you have office, retail, and industrial properties, and then in the middle, you have multifamily and condominiums. So that's a bit about the types of properties, deals, and models. Let's now look at the step-by-step process to real estate financial modeling. First off, you have to start by setting up your transaction assumptions. You have to specify the property size, the price if it's an acquisition, or the development costs if it's a development model, and then the exit details such as how much you're going to sell it for and how long you're going to hold on to it. If it's a development model, you'll have to project the construction period and then draw on debt and equity over time to fund the development. Then for both development and acquisition models, you will build the operating assumptions, which could be very high level or very granular depending on the property type and the market that you're in. You'll use those assumptions to build the pro forma, which is like a combined income statement and cash flow statement for a property, and you'll go down to net operating income, adjusted net operating income, you'll project the debt service, the interest and debt principal repayments, and then you'll get to the cash flow to equity at the bottom. Then you'll calculate the returns, including the initial upfront investment, the cash flows generated over time, the exit and the debt repayment upon exit. And then in step 6, you will make an investment decision based on your criteria and the model output in different cases. Let's look at an example of how this works by going to a simple acquisition model here. We're going to look at a 76-unit multifamily property in Arizona called Arcadia Gardens. Our plan here is to boost rents and reimbursements via minor upgrades, not enough to be a full renovation, just some minor improvements to the property. We'll give away fewer concessions to tenants, such as fewer months of free rent. And in exchange for that, we will let the vacancy rate rise a little bit because we think the benefit of higher rents will outweigh the drawback of a higher vacancy rate. So in step 1 here, we have to set up our transaction assumptions. And in this model, you can see how this works. We determine the rentable square feet in the property by taking our number of apartment units and multiplying by the average rentable square feet per unit. And then we get the total gross square feet in the property by applying a rentable to gross square feet ratio. We also make an assumption for the purchase price around $10 million US, which is based on a cap rate. We make some assumptions for the loan to value ratio, how much debt we're using, and we set up a sources and uses of funds schedule here as well. Then in the next part, we project the construction period, except this is an existing property, so there is no construction period. So we just move to the next step, which is the operating assumptions. Now, for a multifamily property, since there are so many units and everything is so similar, there's no point going into granular detail. So most of these will be based on per unit or per square foot metrics, and the same for the expenses and the other cash flow line items as well. So here, for example, we have a market rent figure and then an in-place rent figure, and we have a growth rate for the rental and parking income right here. And then we can see that right now, the rents are below market by about 10%. By renovating the property, we aim to reduce that discount to only 1% by the end. So those are some of our high-level assumptions for the rent. We also aim to reduce our concessions here from 3% of effective rent down to only 1%. We aim to boost our utility reimbursements. And then we have some assumptions for the property tax growth rate and the operating expense growth rate here. And these are both simple percentages. We have a lump sum number based on the historical year, and then these grow based on set percentages over time. And we have some assumptions for the capital expenditures corresponding to the minor improvements here. You can see our vacancy rate also goes up from 0% right now, which is astounding, up to about 3%, which is more in line with what you'd expect for multifamily properties. So those are some of our high-level assumptions here. Once we have those, then we can build our pro forma, which is fairly standard. We'll also use the IPMT and PPMT functions for the debt service because it's simple fixed rate debt with no accrued interest and no interest-only periods. So for our pro forma, we start with our base rental income, our potential rental income at the top as always. Loss to lease shows us what we're losing because of that discount to market rents. Then we have our concessions and bad debt. So tenants not paying, tenants getting free months of rent and so on. We get some income from parking spaces. Tenants reimburse us for some portion of their utilities. And then we have general vacancy. So spots, units that are unoccupied and that we have no plans to occupy with tenants in the near future. Then we have our expenses, property taxes, insurance, utilities, management fees, sales and marketing, replacement reserves. That gets us to our net operating income. Then we have our capital expenditures, and we have our reserves to pay for capital expenditures if we have enough set aside to actually do that in the given year. That gets us to our adjusted net operating income. And then for the interest expense on debt, this is simply based on the loan interest rate, the loan amortization period, and the total amount of debt that we have, and we use the IPMT function for that. We also repay debt principal each year, and because of the IPMT and PPMT functions, these add up to the same number, $413,000 in each year. That gets us to our cash flow to equity, and we also track our debt balance and some of our credit stats and ratios like the interest coverage ratio and debt service coverage ratio over time. The next step here is to look at the returns and calculate these on both an unleveraged and leveraged basis. This is fairly simple for this deal because we just have the initial equity investment, so the initial 35% or so of equity that we use to purchase this property. We have cash flows coming in each year, so those add to our cash flows. And then we exit the property. We made an assumption here based on a 6% cap rate, and we exit in about 5 years' time. So we exit for about $12 million after purchasing the property for about $10 million. We repay debt at that point. We pay some fees associated with this, and we get to around a 15% return. On an unleveraged basis, the IRR is more like 9 to 10%, which is still pretty good for a stabilized multifamily property. So do we do this deal? Do we buy this property? It depends on the returns that we're targeting and what this looks like in different cases. A 15% IRR is pretty good because the normal goal for a stabilized property like this might be 6%, 8%, 10%, something in that range. But we've only looked at this in one case. We want to test the numbers and stress test this a little bit more, see what it looks like in a downside case, an upside case, build some sensitivities, and look at what happens when rent rises more quickly and more slowly than expected. And then we could make a decision here with more conviction. So that's an acquisition model. I'm going to go into a brief aside here and look at renovation models because they're very closely related. Renovation models are similar to acquisition models, but there are a few key differences. First off, you need to have renovation costs that reduce cash flow to equity or that are included in the upfront price. There must be a penalty during the renovation period, like a lower occupancy rate, fewer tenants, lower rents, or something else like that. And then you must have a benefit following the renovation, such as a higher occupancy rate, an additional major tenant, or average rent that increases. Oftentimes in a renovation, once the renovation is done, the initial loans to finance the acquisition will be refinanced into permanent loans. The risk profile and returns of the property change once the renovation is done, and so you take out previous lenders, bring in new ones that have different goals that are more aligned with a stabilized operational property. And then the exit assumptions are a bit different because it's more reasonable to assume that the property's value increases because you just completed a renovation. So of course, that should make the property more valuable. Whereas if you would acquire a property and don't change it much, that assumption is a bit questionable in a lot of cases because the property gets older over time and doesn't really improve in a meaningful way. To show you a quick example, in a hotel renovation model that we have here, we have assumed for the renovation costs here, we acquire this hotel and then we spend a bunch of money to renovate it in years 3 and 4 of the model. This is for a hotel property in Australia. Those renovation costs directly reduce our adjusted net operating income and also our cash flow to equity. So those are the renovation costs. The penalty here is very simple. We have a renovation factor that reduces our available rooms by 50%. So our occupied room nights here go down by about 50%. And then right afterward, we get a benefit because our average daily rate, the average rate we get for our hotel rooms goes up, and our occupancy rate also goes up. In addition, we have a permanent loan refinancing here. So initially we have some acquisition loans. These get refinanced with a permanent loan when the renovation is done. And then the interest and principal repayments are different as a result. And then in terms of the returns here, we assume that this property is sold for around a 9% or 8.7% cap rate. If you look at what we purchased it for, the cap rate was around 8.8%. So it's not exactly a huge improvement, but it's a modest improvement. We buy it for 8.8%, we sell it for 8.7%, meaning the property's value has gone up, its NOI has certainly gone up, and so its exit price is substantially higher than its purchase price. So that's a quick example of a hotel renovation model. Let's go into part 4 now and talk about a simple development model. The scenario here is that we purchase 18 acres of land in Alberta, Canada. We build a warehouse, an industrial property, we lease it out to 2 major tenants, and then we sell the excess land, and then we sell the property itself at the end of around 6 or 7 years. For the transaction assumptions here, we have the land and construction costs, we have the timeline, and then we have the equity versus the construction loan based on a loan to cost or LTC ratio. You can see all those assumptions up here. We're buying 18 acres. It's going to cost us $700,000 per acre, so we get to our land acquisition costs like that. We calculate our construction costs based on the gross square footage of the property and the construction cost per gross square foot. We make an assumption say that we use 50% debt and 50% equity to fund this property, and we have it all set up like that. Then in the construction period, we distribute these costs over a year. We draw on equity first and then debt to pay for them. So on the construction projections tab over here, we have our land acquisition costs first, then we distribute our construction costs. Initially, we are nowhere close to the maximum amount of equity that we can use for this project. So we can draw on equity to pay for all these costs. But midway through the first year, that flips, and then we draw on our maximum amount of equity, and so we have to draw on debt to fund the rest. We have loan fees and interest on this debt, but there's no cash flow during this construction period, so all these are capitalized and added to the loan principal balance instead. So that's how the construction period here works. For the operating assumptions, we only have 2 tenants, so we just make tenant by tenant projections here for the rent, the concessions, and other items. If you go down and take a look at this, we have the base rental income for tenant number 1, and we have the year in which the lease is up and the turnover vacancy that might be possible there. We have concessions and free rent. We have the tenant improvements for when the tenant first moves in, the leasing commissions based on the term of the tenant's lease and a percentage of the total rent expected to be paid over that term. And we do the same thing for tenant number 2 as well. Then we use all that to come up with our pro forma. The debt service and the permanent loan financing here, or refinancing, are a bit tricky. Most of the pro forma is straightforward. We have base rental income, we have adjustments to it, we have our general vacancy, and then we have our expenses and our NOI. The tricky part here is that this permanent loan that we use to refinance the construction loan has a 55% LTV ratio. But when this refinancing takes place, the property is not yet stabilized. So we need to get the property's value 1 year after the refinancing takes place, which is about $32 million here. Once we have that, then we discount it back to its value at the time of the refinancing based on a 15% discount rate, and we get to the permanent loan amount based on that. So that's how we get to that number here, and then we just use simple IPMT and PPMT functions to project the interest expense and principal repayment on this permanent loan, and we get to the cash flow to equity investors below. We calculate returns based on the upfront equity draws, the refinancing, which takes place at the end of year 1 here. Construction for industrial properties such as warehouses tends to be pretty quick. We have cash flows, we have the sale of excess land midway through, and then we have the exit and the debt repayment at the end. Let's take a look at all that. So in the first year, we draw on a certain amount of equity to fund the project. We refinance with a permanent loan here and repay the construction loan. So all that factors into our cash flow to equity investors right here. Then we have additional cash flows that are generated throughout. We sell the excess land here in year 4, and then we exit in year 7 at the end. So we sell the property, we pay some fees, we repay debt, and we get to an IRR here of around 20% on a leverage basis. Once again, we don't have scenarios, so it's tough to make a real investment decision, but we'd probably say this is a no because we just barely get to a 20% IRR in the base case. The target with new developments is often above 20%. So if we're just barely reaching that without even stress testing this, we're pretty pessimistic about this deal. There are also some issues with buying so much excess land in the beginning. Around 57% of the land is excess, so we don't need to buy that much land up front. The waterfall return schedule here also creates some issues because it puts certain investor groups, specifically the limited partners here, us, the third-party investors, at a slight disadvantage relative to the developers. That's it, so let's do a quick recap and summary now. The point of real estate financial modeling, very simply, is to analyze a property deal, either an acquisition or new development, from the point of view of equity investors and debt investors, lenders, and then make an investment decision based on the risk and potential returns of the property. You determine whether or not the targeted range of potential returns is plausible or implausible, and then go based on that. The three main types of deals and models are acquisitions, renovations, and new developments. The four main types of properties are category number 1, office, retail, and industrial, category number 2, hotels, category number 3, multifamily, and then category number 4, condominiums. The step-by-step process is to first create your transaction assumptions, then project the construction period in a new development, then set up your operating assumptions, then create the pro forma, then calculate the returns, and then make an investment decision based on that. And you saw examples of that with the simple acquisition model and a simple development model. Hopefully, this now gives you a good overview of what real estate financial modeling is, how you can use Excel to answer these types of questions, and what could come up in interviews and case studies on this topic. And once again, you can get all the Excel files, screenshots, and accompanying documents if you go to that link, mergersandinquisitions.com/real estate financial modeling.